I'm Jason DeNicola in the MBA program. I'm an accounting major, so I'll be focusing on being able to read the financial statements, be able to analyze them and determine the ratios, what they mean. So that would be what I would contribute to the project.
I'm Nico Vara. I'm a senior finance major, economics minor. In terms of bringing things to the table, I look at myself as an extremely hard worker, and I'll put in all the hours needed to do whatever it takes for the team to succeed. And I'm fairly good at modeling and whatnot, so I think overall just putting in the hours and just doing whatever it takes for us to do well is what I'm ultimately here to do. So,
I'm Stephen Kozak, senior finance major. I want to be a part of the challenge because this year I'm in student managed investment fund, and I think that coupled with this experience will help me bring some pretty valuable equity valuation skills to the table. Today we're doing our analysis project on Coach. So just to give a quick overview, Coach is a very large luxury retailer focusing in on women's handbags. Mainly about 58% of their revenue comes from women's handbags. They also have a smaller men's division as well as some women accessories, which consists of things such as footwear and jewelry. They recently just purchased Stuart Weitzman earlier in the year, which is a wholesale shoe retailer, mainly selling to places like Nordstrom's. Switching to a global picture from a geographic perspective, Coach has the majority of their exposure to the United States, which makes them a little bit better from a rising dollar perspective as you take currency into effect, and as well as some of the market volatility in China.
Before digging into the financials and getting into key metrics, we just wanted to go over a quick SWOT analysis. Some strengths that we thought Coach portrayed was premium brand quality. Obviously has a strong brand recognition. They have a high dividend yield of around 5%. We feel their customer base, although may not be a big particular group, they have a loyal customer base, as well as a multi-channel global distribution model that we feel is very effective. On the other hand, some of their weaknesses are their cash flow, we believe, is going to be decreasing over the future. They have a low retention ratio. Their cost of producing their products is relatively high. That's certainly a weakness. Management has not strategically entered growing markets, so we felt that certainly is a weakness, and their levels of inventory are high. Nico's going to tell you a little bit more about their opportunities and threats.
Yeah, so in terms of opportunities, a major opportunity for them would be to strengthen their economic outlook with a consumer spending increase. They also should look to increase exposure in emerging markets. It's such a premium brand, and getting it into certain niches within certain countries that have a lot of money, it would be a very good opportunity for them to get into. And also just to grow the company's online presence. We live in a very tech-savvy day and age, and doing a lot of advertising online and getting the name out there in certain consumer market areas would be a good idea. In terms of threats, there's a lot of global macroeconomic instability, specifically in China. The yen is down, it's not valued very high, so that's certainly a threat. There's a lack of interest in their product lines from certain market segments, and I'd mentioned tech crowd just because, I mean, in this day and age, a lot of people in, say, Silicon Valley don't really look at Coach as a particular attractive product line in terms that they're very conservative in terms of what they wear. They also have strong competition like Michael Kors, and also during the tough winter season, it has created a negative impact on demand. So,
I think it's also important to add that the global macroeconomic instability in China is a threat, yes, but We also believe that because they don't have as much exposure to China, that it won't affect them as big as it would, although if they begin to start entering into emerging markets, that could be a threat down the road.
Before getting into our evaluation of the company, we just want to take a look at their performance. We chose to look back about 5 years. As you'll be able to see in our presentation, sales have been on a constant decrease over the past 5 years or so. Correlating is their gross income, and consequently their net income has decreased steadily over the past 5 years, and we'll take a look into that. So we put together a quick DuPont analysis, which we'll then compare to their competitors. We got a return on equity of 0.16, which compared to the market. So we have the net income compared to Kors and Ralph Lauren is certainly less, and but their sales, however, are right up there with them. So their profit margin is about right up to par with them. The total asset turnover is substantially lower than Michael Kors and Ralph Lauren. So this means they're not utilizing their assets as well as other members in the industry. So this is certainly an area that they have to concentrate in. Their financial leverage is, we determined, to be right up to par with Michael Kors and Ralph Lauren. So.
The next method of evaluation we looked at was the method of comparables, particularly the PE and the EV over EBITDA, excuse me. For the PE, we valued the firm to be at $37.18, and we also, for the EV over EBITDA, we found it to be at $34.58, which we found were relatively safe numbers. So, yeah.
The next valuation method that we did was free cash flow valuation. As we discussed, free cash flow has been decreasing over the past 2 to 3 years at about, on average, about 25%. With that said, we believe that the biggest drop from 2015 and 2016 will be around the 25% mark, and then a little bit more that will decrease as we move into 2017 and 2018. 2017, we believed it would decrease about by 2%. And then in 2018, we expected to kind of get back to its growth rate, which we've calculated to be around 1. And the reason for that is because of their new transformation plan that they just announced at the end of their fiscal year this year. They hope to focus on decreasing their inventory and turning over those assets, as Jason said, as well as kind of targeting the internet growth market. So with that said, we came up with a free cash flow valuation of about $35.64. Now, as we conclude and we weigh our different investment decisions, we didn't take into consideration the dividend discount model. Nico, you want to touch upon that?
Yeah, so it's been a rough few years for Coach, and they've always held strong with really paying back to their dividend holders and paying a lot to the dividends. And right now they're continually to issue the dividends. I believe it's at 4.6%. 4.6%, and that's really being done now to just keep investors happy and feel like they're safe. And we eventually think that they're going to crawl out of it, and that's why we advise today to buy the stock. I don't know if Jason or Stephen has anything else more to say.
Yeah, so we kind of just projected a 22% upside based on this transformation plan that they're putting in place, and our belief that they can expand into some of these emerging markets where they haven't been in the past, as well as the Stuart Weitzman purchase towards the beginning of the year. That could be a pretty nice catalyst for them, as stores like high retail stores or luxury retail stores like Nordstrom's on the wholesale side tend to do pretty well, even given economic cycles, just because of the brand name recognition.
Right, and to finalize, so we feel the stock is undervalued, so we think it would be a good purchase. Thank you.